Hi, this is Manesh Patel with Valetax. Today, we are going to discuss the high probability strategy for Ichimoku. For the last couple of months, we've been talking about Ichimoku and all the individual components. As you know, now there's 5 indicators that make up the indicator. And of those 5, it's basically, there's 4 main elements. So 2 of the elements, the Senecal A and the Senecal B, pretty much create the cloud. So we count that as 1. So we discussed the cloud strategy. Then we discussed the Tinkinson, which is basically support resistance for 9 bars. And we represent that with red color. Then we talked about the Cajunson, the container of the trend. And it's basically green. It represents support resistance for 26 bars. And then last time we discussed momentum. So there's 4 main elements that basically make up the Ichimoku system. Today, we're going to put everything together and talk about how to create a strategy out of that. Individually, we talk about each individual component and how to create a strategy there. But today, we're going to take it and all combine it all together and show you the high probability strategy. Okay, and I'm going to show you a couple of trades I've taken that you could see. 2 of them would be with Bitcoin. 1 of them is with the Japan market and so forth. And I'll show you exactly the thought process behind each trade and go from there. Because the best way to learn Ichimoku or any technical system is live in the market, talking about live with charts and stuff like that. So we'll definitely do that in a couple of minutes. So let's begin. As you know, I believe in the method called KISS, keep it simple. Remember, we're here to trade probabilities, not to gamble. To trade probabilities, you have to be consistently following your trading plan. To do that, it has to be simple. If your trading plan is too complicated, there's no way you're going to be able to trade successfully with probabilities and keep your emotions out. So the simplest trading plans, believe it or not, are the best ones. I know a lot of people get caught up in technical analysis of fundamentals and stuff like that, but really, that's not the method to go. With my background in engineering and programming, I went down that path of complicating things, looking at thinking technical analysis was everything, but it's not. It's technical analysis with money management, and money management is the key to be consistently profitable. So, as we discussed before on the very first Ichimoku workshop, we discussed the cloud. And this is the most simplest thing. And this helps you drastically because it tells you the direction that you're trading. A lot of people spend minutes or hours looking at a chart just to determine which way they want to trade. Are they going to bet on it going up? Are they bet on it going down? Are they not going to trade it at all since it's consolidating? And that's the biggest dilemma a lot of people have when they look at charts. You're supposed to be able to look at a chart within 3 seconds or 1 second, be able to determine the sentiment for the instant. Then you can determine whether you want to enter or not. With Ichimoku, it simplifies things drastically. And in 1 second, you can determine whether it's bullish, bearish, consolidating. And that tells you a lot. So if price is above the cloud, when we talk about price, we're talking about the closing price. If the closing price is above the cloud, then the sentiment's bullish. If the closing price is in the cloud, that means it's consolidating neutral. If the closing price is below the cloud, that means it's bearish. Okay, and that's it. So that's all you need to know, and it keeps it very, very simple. A lot of people love that. Some people are scared of that concept because they think, well, it's too simple, it doesn't work. No. Ichimoku, as we talked about, was invented back in 1929 with these standard parameters. They still work today, and they still work in the future too, for a lot of reasons. Okay, so just believe in the system and go from there. So now what we've done is we talked about this here. Okay, and you can see here we're waiting for 2 bars and stuff like that. You know this slide here. Okay. And what I did was I updated it here. So here we're looking for basically price to break out of the cloud. Okay, that's the very first time it goes from consolidation to bullish or consolidation to bearish. We're doing that reason why is Our goal always is to be consistently be making money, be profitable. To do that, you have to have a good reward risk ratio. Okay. To have a good reward risk ratio, you want to get in at the beginning of the trend. If you get in at the middle of the trend, you really don't know how much reward is left. And at that point, you could keep your risk low, but if there's just a little reward left, then you don't know what your reward risk is going to be. So your goal always is to enter the beginning of a trend. And that typically is established when you go from a consolidation pattern to either being bullish or bearish. And that's what number one is that you're looking for price to be in the cloud, specifically 2 bars, to establish it's a consolidation pattern, and then you're looking for it to break out of the cloud. And that's what you're looking to do. This is talking about here. Now what we've done is that we've talked about the momentum. So when it comes out of the cloud, you want to make sure you have the correct momentum. If you're trading a bullish, you want to make sure you have a bullish momentum. If you're trading a bearish, you want to have bearish momentum. So what we're doing is we're incorporating all the other Ichimoku elements into the cloud breakout strategy. So it helps us with our win-loss ratio in that when it comes out of the cloud, it could be a true breakout or it could be a fault. By incorporating the other indicators and other elements of Ichimoku, you're improving your win-loss ratio. So by trading out of the cloud, you're getting a good reward risk ratio. By incorporating the other indicators that are part of the Ichimoku system, you're improving your win-loss ratio. So we're improving everything based on all the Ichimoku elements. So number 2 is basically you want to make sure you have a good momentum and also you're on the correct side of the Tinkerton and the Cajunson. And I'll show you more of this when we get to the charts in a minute. Then everything else is the same. So basically what we did was in the 4-step process to trade and execute that we talked about with the cloud strategy, what we're doing is before we take a trade, we're going to make sure the momentum, the Tinkerton and Cajunson are in our favor, okay? So what we did was we make sure we break out of the cloud, correct momentum, correct Tinkerton and Cajunson. So those are 3 rules that are there that we want to make sure before we can take on a trade, okay? Now, for the high probability strategy, you want to incorporate the future cloud. And what do I mean by that, okay? So remember, the Ichimoku cloud is shifted back 26 bars in the past. Okay, so when you look at a chart, you're going to see that basically price is above the cloud or below the cloud. But if you look to the right, there's a future cloud projected. Okay, so when you're looking at price versus the cloud, you're looking above you or below you. You're comparing the current price to everything that happened 26 bars ago. That's basically the cloud below you or above you. When you look at the future cloud, that's telling you the current state now of what's going on with price. Okay, and remember, the cloud is made up of 2 indicators, the Seneca A, which is roughly around support resistance for 18 bars, and Seneca B, which is roughly around support resistance for 52 bars. But you really don't need to know all this details at all. You just need to know how to use it, which we're about to go through. So all you have to do for the 4th rule, and remember, there's 3 rules right now. For bullish scenario, you want price to be above the cloud. You want price to be above the Tinkerton and Cajunson, and then you want correct momentum. And this is the 4th rule, which is the future cloud. So you want the future cloud to be bullish, okay? If it's bearish scenario, you want it to be bearish. To determine if the future cloud's bullish, you can look at the color code behind the cloud, but some platforms don't show you color codes at all. But what you could do is basically what it is that the Seneca A in the future is above Seneca B, okay? And that's all you're looking for. So if you look here, this is the live trade here. This is Bitcoin here. This is the current chart, just took a snapshot of it yesterday, okay? So here's the Ichimoku system. And if you look at it here, this is the future cloud. The light gray line that's more squiggly is always the Seneca span A. And the reason why is that's support resistance for 18 bars and it's non-linear. The line that's more flat, this is basically support resistance for 52 bars. Since it goes back a lot further, it has the ability to be more flat compared to the Seneca A. So these two lines here make up the future cloud. If Seneca A right there, the shorter time frame support resistance is below the longer term, this basically is bearish. And in trading view, the cloud is colored red. Some platforms will not color the cloud at all, and that's why I wanted to go for the formula. But if it does color the cloud, you just keep it simple. This is bearish, that's a bullish color, and that's it. So all you're doing is reading that. And remember, the current bar here is here. So this cloud, when you look at the current price and look above you or below you, this price action here is from 26 bars ago. The current price action is forming this future cloud right there. Okay. Does anyone have any questions in regards to the future cloud? Nope. Okay. So this is basically the future cloud here. Okay. And it's pretty simple when you look at everything here. And what you're looking for is, for a bearish scenario, Seneca A is below Seneca B, okay? And that's what you have here. So now, the high probability strategy is very, very simple. It's basically putting everything that you've learned together. That's all it is. There's nothing new really at all, except for the future cloud, which is just reading the color, believe it or not. So if you look here, this is what you're looking for, a bullish scenario, okay? And let me just do the PowerPoint here. So the bullish scenario here is you want price to be above the cloud for bullish. Then you want the closing price to be above the Tinkinson, which is the red line. And then you want the red line, which is the Tinkinson, which is support resistance for 9 bars, to be above the green line, which is support resistance for 26 bars. Okay, so basically, if you're looking at the order from top to bottom, you want the closing price, the red line, and the green line. Closing price, Tinkinson, and Kijinson. So you want that exact sequence of price there. If that's there, then you're good to go. Then you want momentum to be bullish, and now you want the future cloud to be bullish. Okay, so these are the 4 rules that dictate a trend. So to have a good, strong trend, you need these 4 rules. If one of the rules is false, a pullback can occur at any time. And that's the key thing to note. Okay. Mark had a question. When a cloud gives a signal, but the other indicators disagree, which one do you trust the most? Well, Mark, as I mentioned here, a lot of things can happen especially with volatility today. And what can happen is if you have 2 of the 3 rules or 3 out of 3 rules, you could go up with volatility. But if you don't have all 4 rules, at any time you could go for a pullback, and it could literally destroy your whole trade completely. So your ideal scenario is to make sure you have all 4 rules at all time. If you do, your probabilities going for a major pullback are small. Now, of course, you're always going to have pullbacks when a trend exists, but you don't, and they're minor pullbacks, but they don't ever want to go for a major one, which is critical. Does that make sense? And the good example would be is that if you had a chance to look at Ichimoku and every time it comes out of the cloud, there's a lot of scenarios where you're going to have where price comes out of the cloud and it doesn't go anywhere. In fact, it reverses. And that's typically because one of the rules are not true at all. Okay. And I'll show you some examples of 3 trades here in a couple of minutes. One is long-term, 2 are long-term, one's more day trading type of scenario where we're looking for all the rules. But before we were looking for just the cloud breakout, now what we're going to do is we want to make sure you got 3 out of the 4 rules. When you got 3 out of the 4 rules, then you're going to sit there and place an order for a breakout trade for the 4th rule to become true. So we're not just looking for it to break out of the cloud now, but when it breaks out of the cloud, you want to make sure you have all 4 rules there. If you're not, don't take the trade. And I'll show you that with some live examples in just a moment. Okay. So this is the bullish strategy here. The bearish, of course, is the opposite, where you're looking for price to be below the cloud initially. Then you're looking for basically the price to be below the Tinkinson Cadenson. So in the sequence from top to bottom, now you're looking for is the cadence in the green line, then Tinkinson, the red line, and then price. So you're looking for that sequence of order to occur. Then you want momentum to be bearish, and then you want the future cloud to be red. In this case, if you need the formula, it's Senecal A below Senecal B. Okay, so this is what you're looking for a trend to start to occur. Okay, now let's go through, and as I mentioned, if any of the rules are false, a pullback can occur at any time. Okay, so let's go through and look at some trades. So here's Bitcoin here. If you look at Bitcoin here and you analyze the 4 rules, 1, price is below the cloud, price is trying to break the cloud. So right now you're touching the Senecal B, the bottom part of the cloud, has not broken out. So the price being below the cloud, which is the first rule, is false right now. Okay. Then we're going to look at rule 2. And in rule 2, since it's bearish, what you're looking for is basically to be the green line, red line, and closing price. So here's the green line, which represents 26 bar support resistance. The red is right there, which is 9 bars. So 9 is below 26, perfect for bearish. And then you have the closing price here. So now you've got everything established here. So this is true. So rule 2 is true completely. Okay. Next, you look at momentum. That means you find the Chicago span, the purple line on my chart right here, and then you look above you or below you, and you can see this purple line is below the price from 26 bars ago. So this is bearish too. So rule 3 is true. And now rule 4, you're making sure this future cloud here is bearish, which is red in our chart. So that's perfect. So here, you have 3 out of 4 rules. That's a perfect scenario. So if you break out of the cloud here, now now all you're going to do is this rule right here is going to become true. So this is why you do a breakout order here. When you do a breakout order here, that will force price to become below the cloud, and now you have all 4 out of 4 rules. Does that make sense? Yes. So this is a live trade here. And if you look at it here, the next bar, if you take a breakout trade here, and you can see here, price closed below the cloud here. So if you look at all the rules here, price is below the cloud now. You've entered the trade. Rule 1 is true. Rule 2 is true because you have the green line, red line, and closing price. You have momentum here is bearish since it's below the price from 26 bars ago. And now you have basically the future cloud, which is basically bearish too. So you have all 4 rules for the trend to basically occur. And that's the high probability strategy here. And you can stay in this trade as long as price does not break the green line. If you're looking to take some profit for the sub points, you could use the red line as a trailing stop, but the trend will stay as long as the green line is respected. So if you look at the current chart today from the last 9, this is what Bitcoin looks like on a weekly time frame. You can see it went all the way down here, and you can see here if you entered here, use the interbar high as your stop right there. There's your risk right there. And you can see you easily got to your 3-to-1 reward risk ratio right there. And then here, you can see we never closed above the green line at all. So we retested the spike bottom here in Bitcoin as of right now, and we're still here, and this bearish trade is still intact. Any questions on this? No? So now what we're looking for is 3 out of the 4 rules, and then we're going to do a breakout trade for the 4th rule to be basically become valid. Okay. So let's go for another example here. This is the Japanese market here, okay? And over here, you could see here, what's the rules? So rule one, prices above the cloud. You got prices above the cloud. Rule two, you want the price, since this is bullish, you want price, red, and green. The red and green are inverted. So that means this is neutral. Rule two is not true at all. Momentum. If you look at momentum here, there's momentum right there, and it's below price. So the momentum's bearish. And then rule four, this is bearish too. So even though you're breaking out of the cloud, you really only have 1 out of 4 rules that are on your side. So this is not a good cloud breakout at all. So I would not be taking this trade at all. So if you look at this here, eventually decides to consolidate, and at this point right here, let's look at the rules. So at this point now, price is still above the cloud. That's good. Now you got price, red, and green, which makes the second rule true. Momentum here is touching price, so that's neutral. And then you have the future cloud here, which is basically being bearish. That's not good. So you got 2 out of the 4 rules. So you need to be patiently waiting for one of the other rules to become true. At this stage here, and this is the stages we looked at this stage here, now you have price above the cloud, which is rule 1, price, red and green, which is rule 2. Momentum is touching price still, so that's basically neutral. And the future cloud is now bullish. So now what you can do is you have 3 out of the 4 rules. So what you could do is do a breakout trade on the next bar to assume that this here is going to come out of price and your 4 rules are going to be true. So you're forecasting, whenever you get 3 rules true, you're going to do a breakout order to get the 4th rule true and assume that happens. So when you did that here, did a breakout order, it did not occur at that point, but over here, the breakout order occurred, and this is where you enter the trade here, and you can see here, you enter that trade, at that point, momentum is out of the cloud, future cloud was bullish, you're above the cloud, everything. So this is the trade where you entered here, and then you could see it went really, really good, going all the way up. And then it violated the green line here. So this is where you took profits there. Any questions on that? But this is a good example where you came out of the cloud here and it did not take off at all. And you could see the reason why is that you only had 1 out of 3 rules. And the biggest main rule, believe it or not, with the cloud strategies is this momentum. Momentum is the very, very, very key aspect. The tinkers and cages, you can kind of get away with. The future cloud, you can get away with. But the momentum, if the momentum's against you, you're definitely not going to go your way. And in this trade here, if you entered it here, then it came back in the cloud. Believe it or not, you had a jeopardy of here where it's going to go back below the cloud here. And the people here, they didn't do that, just got lucky. Okay. Any questions in regard to this trade? Okay. So here is another example. This is looking at the NASDAQ here. Okay. And this is a different scenario in that you were bullish here, and then all of a sudden you went below the cloud here, below the green line here, so the trend was destroyed. Okay, so now we're looking at this for a trend continuation trade, where it's already came out of the cloud, now it went below the green line and see if it could continue. So again, you're looking for the 4 rules to become true for a trend continuation. In here, price is above the cloud, so that's good. Tickets in the cages in your price, green line, red line. That's wrong. So that's neutral right now. It needs to be the red needs to be above the green. So that's not good at all. Momentum here is bullish. It's barely above the price, but it is bullish. And the future cloud is bullish. So at this point here, we have 3 of the 4 rules. So what we could do is do a breakout trade on the next bar to assume the red and green will correct itself. And if it doesn't, you could exit the trade, but you could enter on the next bar, assuming that all four rules would be true. And when here you entered there, you already closed up here. So now if you look at the four rules here, price is above the cloud, that's good. You now have the price, red and green are correct. Momentum's bullish and the future cloud is bullish. And now, so you entered a trend continuation trade with everything valid and everything good to go. Now all you do is manage it. And you can see as of today, of last night, this is still going very strong. It hasn't even touched the red line at all. And this trade is very active and still going on very strong. Okay, so this gives you an idea of a trend continuation strategy compared to the beginning of the trend. So in a lot of scenarios, if you're still above the cloud and it broke the green line, as soon as it breaks the green line again here, you could start looking for a trend continuation strategy and look for all the rules to become true. And once they do, it could start the trend, retest the high, break it, and go higher. Everyone good? So we discussed 2 points. One is when it's coming out of the cloud and start looking for 3 of the 4 rules. When you have them, do a breakout trade for the 4th rule to become true. So that's basically coming out of the cloud. So your reward risk is good and at the beginning of the trend. The second scenario is where you're still above the cloud, you broke the green line here, you went below it, and then you came back above it. This now counts as a trend continuation trade, okay? And you'll be looking for all 4 rules to be true for the trend continuation trade. So we discussed 2 points now. One is the beginning of the trend, and one is trend continuation. Any questions up to this point? No? Okay. Next is a day trade. This is Ethereum. Okay. This is 1 hour. I took a snapshot of this yesterday afternoon. So here, price is below the cloud here. This looks ugly and completely ugly. If you look at the volatility here, this is a 1 hour chart for Ethereum, and you can see it looks really, really ugly. But just keep the emotions out and just follow your rules. So here, price is below the cloud. If you look at it here, you have basically green line, closing price, and red line. So this is not in sequence at all. So you're looking for it to basically go down, okay, neutral. So momentum here is bearish and future cloud is bearish. So you got 3 out of the 4 rules. So what you could do is do a breakout order below the low of this bar here. And then once you enter, you could look to see if all 4 rules are true. If they are, then stay in the trade. If not, you exit the trade. So if you look at it here, next bar here, you entered here, and next bar here at the end of that bar, now you have green line, red line, closing price. So you have price below the cloud, rule 1's true, rule 2 is true, rule 3, momentum is true, and rule 4 over here is true. So you could look at this trade here, and you could see the results here, which is right there. So you can see it went all the way down here, right there. So it definitely gave you a 3-to-1 reward to risk ratio. And remember, you entered right there. So you captured this volatility movement down there, broke the red line here, and then eventually broke the green line here, okay? So now it basically the trend is over for now. And so it's going for a major pullback. Now you're going to wait to see if it breaks the green line again, which is right there. And at that point, you could see that all 4 rules are true. So then you could do a breakout order here, right there. And then you could re-enter this trade going down. And you could see you got another trend continuation leg here that you made 3-to-1 reward risk ratio. So there was 2 points of entry. One was right there. and then one was right either here or here, depending on your buffer below the low. So one is the second one right there. So you have 2 day trades here for Ethereum on the 1 hour with the system. Any questions on this? Mark, you said you want to look at US yen. What time frame do you want to look at? So I'm just going to live charts now. So here's US yen here. Do you want to look at weekly? Do you want to look at lower time frames? Weekly. Okay, so let's go back and give me 1 second. Okay, let's do replay here. So this is when it came out of the cloud here. Okay. So when it came out of the cloud here, you could see prices above the cloud. So rule 1 is true. Rule 2 is you're looking for price, red line, and green line. So rule 2 is good. Over here, the purple line here is above the price from 26 bars ago. So rule 3 is good. The future cloud is not good at all over here. So what you could do is you could do a breakout order. Here, I'll just do a vertical line here above this point right there to assume basically price will break out. You okay with that? Yes? So let's look at this here and see what happens. And you can see here, next bar price did not break out there. We're going to keep on waiting. And boom, right here, price hit that level here, our breakout level. Notice the future cloud has not flipped yet, okay? And whoa, oops. So at that point, you enter here, the future cloud is not flipped, you would exit that trade, okay? So now let's go back to this scenario here. So you exit that trade on that green bar right there. You came out with a little profit here. Future cloud is still consolidating here. Now what you do is you look for this green bar here, do a breakout trade above there. Probably the next breakout would flip this here, the whole thing. So here, so you can see it did. It touched the entry here. You can see the cloud flipping now. So now you stay in this trade here, and then you just have to manage this trade now going forward. And so you could see that you entered there, you hold in the green line here, still holding it, still holding it. It's still holding it. You haven't closed below the green line at all. And this is the current chart for here. Do you see that? So basically you would enter roughly right here. Right there. But you could see that this is not smooth. And the reason why you had a lot of fluctuations in here is because all 4 rules were not true coming out of the cloud. When you get that, then it could cause a lot of little pullbacks along the way. Do you see that? Your ideal scenario is when you come out of the cloud, you want all 4 rules to be true. That way it just takes off with a lot of momentum and everything right away. Over here, it took a little while. It went up, then came down, came up, then down, and so forth. But it still held the green line, so everything's intact. Question? Did you have a question on that, Mark? You said, No? Okay. One other way you could do this also is that you could do a multiple time frame analysis where you could look for all 3 rules or all 4 rules here to be true, and then on the lower time frames do the same scenario, but now you go in bullish directions to trade in the time frame the higher directions. So when this started happening here, you start looking for bullish trades on the lower time frames and start trading it that way. Does it make sense? What else would you guys like to look at? Is there anything else you'd like to look at? Just let me know the instrument and time frame. Would you guys like to look at crude oil? Or gold? Let's look at gold. So if you look at gold here, you could see here, this is below the cloud here, right there, okay? You finally closed above the cloud here, so let's go to this replay mode right there. So this is when they closed above the cloud, above the green line here, and now we're going to evaluate this. So this is the first time it closed above the green line, so price is above the cloud, which is rule 1. Then you have price, red and green, which is rule 2. Then you have momentum, which is rule 3. And now you have the future cloud, which is rule 4. So now what you could do is you could do a breakout trade above that level here. Right there, and then you should be good to go. And you could see here, you really didn't get back above the breakout level at all. This is one reason why you have to wait for you close above the green line, then looking for the 4 hours, the 4 rules to be true, and then you look for a breakout trade. So you could see here it reversed here, and now basically this is going down, okay? So over here, the 4 rules are not true, but if you look at it from a different perspective here, look on a daily time frame, you could see it's a different scenario here. Let's just take this last play here. Gold right there. Let's zoom in here. And here, you can see it's at the edge of the cloud here. So rule 1 is not true. For bearish, it's definitely the green line and the red line are good, but the price needs to be below the red line. So that's okay. Momentum is bearish. And basically here, the cloud here is bearish too. So you could do a breakout order here, right there, and to assume here, all rules are true. So here, the future cloud here, notice one thing. The future cloud is now flipping. So you have rule 1, price below the cloud, the tickets and cadence and all the correct momentum is good. But this future cloud just went neutral, which is bizarre. So look what happened when it did that. It caused the pullback to occur. Now all the rules are true again. So now you could do a breakout order below here if you want, or you could stay in it from that neutral perspective. Now you're in this trade here. You can see you're holding the green line, and you can see you're going down. So the green line, everything held, and you can see the trend started and everything. You will sit there and test this green line a couple of times, especially with volatility. But in this scenario here, this is a little weird because you had a bearish future cloud. When you entered, it became neutral, didn't go bearish, became neutral, and then basically it went bearish. If price had gone up, then it could have gone bullish. But you could stay in that trade for neutral. You could exit out, or you stay in it and see what the next bar does. But this is the scenario where it was, one of the rules was true, and then it went kind of neutral on you, and then it went back to normal. So this is gold here, as you can see. Questions? Here's crude oil. we'll do this last one here. We'll just do it here. So this is what the ones I like the most is when you're testing the cloud here. So rule 1 is not true. Rule 2 is true, but you have green line, red line, and closing price. Rule 3 is true, and the future cloud is true. So you have everything true except basically coming out of the cloud. So at that point, you could do a breakout order here, a couple of points below there, or you could even do it below this little pivot right there. So you could choose whichever one you want, okay? Then you let it broke out. Now price is below the cloud. You take it in cadence in. Rule 2 is true. Momentum is true. And the future cloud is true. So now you have everything for the trend to continue and to stay in. And you could see, look what it did. And you could see crude oil going down based on the cloud strategy, the high probability strategy. Questions? Here's a cloud strategy here. Quickly, let's look at the rules here. This didn't test the cloud on the previous bar right there. So here it did do that. Notice one thing. Prices below the cloud, that's true. Tickets and cadence, that's neutral. Okay, but if you enter below it here, that could become true. Momentum's good, but the future cloud is way bullish. So the probability of this breaking below the cloud is very, very low, since you only have, what, 2 of the 4 rules. You have price and momentum. You don't have tickets and cadence, and you don't have the future cloud. So you have 2 of the 4 rules. So the chance of this breaking down lower right now is low. And look what it did. It reversed on you completely. So this is where the 4 rules come into play to pretty much help you avoid a lot of false cloud breakout strategies. Okay. Any other questions, guys? No? Hopefully you found that useful. Okay. That's it for today's webinar. If you guys have any questions, please feel free to ask in the Telegram chat room. You're more than welcome to post some charts there, and I'll give you some feedback and everything too. Thank you and have a good day.